You clicked this video because you want to know if bonds are still safe. The reality is that for long-term investors, that safety is an illusion. Many people are losing purchasing power because they are holding assets that look stable but are actually decaying. By the end of this video, you will understand why traditional bonds can become an inflation trap and what specific shift you need to make to protect your future wealth. Here is the thing about the word safe. It is a linguistic trap that has misled generations of investors. When we talk about bonds, we usually think of government debt that promises to pay you back a fixed amount of money on a specific date. That promise sounds secure, but the danger lies not in the principal repayment, but in the value of the money you receive. If inflation rises faster than the interest rate you are earning, your real return becomes negative. You are technically getting your money back, but that money buys less than it did when you first invested. This is where the standard advice fails us. It tells you to hold long-duration nominal bonds because they are low risk. In a high-inflation environment, this is a fatal error. Consider how the bond market actually moves. It is driven by yield curve shifts and liquidity constraints, not by the directional sentiment signals that equity models detect. General sentiment models, like those used for stocks, often fail completely in the bond market. They create a false sense of stability during inflationary regimes. This means that when inflation starts to spike, standard analytics do not warn you. They tell you that everything is fine because the bond issuer has not defaulted. But the market has already priced in the fact that your returns will be eroded. The bond price drops because interest rates rise, and that drop is disproportionate to the rate change. This is a non-linear failure mode. A small increase in rates can cause a massive depreciation in the price of a long-term bond. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. This vulnerability is not just theoretical, it is a structural flaw in how we view fixed income. The assumption of safe principal repayment is often wrong because the purchasing power of that principal is what matters. When you hold a long-duration nominal bond, you are betting that interest rates will stay low forever. History shows us that this bet is often lost. The bond market is not a place of guaranteed stability. It is a place where inflation risk hides in plain sight. Standard sentiment analysis fails to capture this because it looks for upward or downward price trends. It does not account for the inverse economic dynamics where rising prices force rates up, which forces bond prices down. This brings us to the core of the problem. Blind allocation to long-term nominal bonds ignores the reality that these assets suffer from negative real returns and duration risk. When rates rise, the price of a 10-year bond can fall by 10% or more in a short period. If you need that money for retirement, you are forced to sell at a loss. You cannot wait for the bond to mature because the opportunity cost of being locked in is too high. You are stuck with an asset that is losing value in the market while the economy around you is paying you a return that is below the inflation rate. This is the trap. It is not a default risk. It is a real return risk. So what is the solution? We need to shift our strategy from blind allocation to active management. The most effective pivot is to move away from long-duration nominal bonds and toward inflation-indexed instruments. These are known as Treasury Inflation-Protected Securities, or TIPS. With TIPS, the principal value adjusts based on changes in the consumer price index. If inflation rises, your principal increases. If inflation falls, your principal decreases. The interest payment is then calculated on that adjusted principal. This mechanism ensures that your real return remains positive regardless of what happens to the inflation rate. It removes the guesswork. You are no longer betting on inflation staying low. You are protected against it. This strategic shift is not just about swapping one bond for another. It is about changing how you view the entire fixed income portion of your portfolio. The industry is already moving in this direction. New models for bond issuance are being built on distributed ledger technology, or DLT. These systems allow for programmable, transparent yield structures. They imply that traditional opaque bond markets may be less resilient to inflation shocks compared to smart, contract-based instruments with built-in adjustment logic. Even in these modernized systems, the assumption of safe principal repayment requires rigorous security audits. This reinforces the need for active, duration-aware management over passive holding strategies. You cannot just set it and forget it. The key insight you need to take away is that the label of safety on long-duration nominal bonds is a linguistic trap. It creates a false sense of security that can destroy your purchasing power over time. General sentiment models like Finbert fail in bond markets because they cannot detect the specific dynamics of yield curve shifts. They miss the non-linear failure mode where rising rates cause disproportionate price depreciation. This is why a duration-limited approach or a shift to TIPS is essential. You must stop treating bonds as a static savings account. They are dynamic instruments that react violently to inflation. If you continue to hold long-term nominal bonds without a plan, you are exposing yourself to the risk of negative real returns. The market will not warn you. The standard analytics will not tell you. You have to understand the mechanics yourself. You have to recognize that the bond market is not immune to inflation. In fact, it is one of the most vulnerable sectors. By limiting your duration or switching to inflation-linked instruments, you take control of your real return. You stop being a victim of economic cycles and start being a strategist. The path forward is clear. Stop relying on the promise of a fixed nominal return. Start focusing on the real return after inflation. Use TIPS to lock in your purchasing power. Limit your duration to reduce sensitivity to rate hikes. This is not about chasing high yields. It is about preserving what you have already earned. The bond market has changed. The old rules no longer apply. If you want to protect your wealth, you must adapt your strategy to match the new reality of inflation risk. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.